Welcome to The Explainer. Today we're decoding a strategic roadmap to take terrifying macroeconomic chaos and turn it into what could literally be the last big wealth-building opportunity of the decade. Look, geopolitical shocks like rising tensions in Iran can seem incredibly daunting, right? And honestly, for unprepared portfolios, they usually are. But today, we're going to explore how a disciplined minority of investors uses this exact type of market fear to set up massive long-term gains. So don't worry, we're going to break down the exact framework you need to navigate all of this.
Okay, let's kick things off with a legendary mindset shift. You know that classic Warren Buffett approach? When everybody's bearish, I'm bullish. When everybody's bullish, I'm bearish. That really proves that true long-term investors actually get excited when there's fear and blood in the streets. A crash or a collapse doesn't scare smart investors, it energizes them. If you're investing for the next 10, 15, or 20 years, you actually want to be buying when the market is panicking. But the secret, of course, is knowing exactly what to buy and having the sheer discipline to execute when everyone else is running for the exits.
So here's our roadmap for today's explainer. First, we'll cover the anatomy of a crash. Second, avoiding the cyclical trap. Third, investing in AI infrastructure. Fourth, building a resilient portfolio. And finally, we'll wrap up with the only metrics that actually matter. Let's jump right into part one, anatomy of a crash and the macro threat we're facing. We really need to demystify exactly what happens to the economy when global tensions suddenly rise.
Think of it like a brutal domino effect. Boom! A geopolitical shock hits, maybe involving Iran, which immediately spikes oil prices. And when oil doubles, the cost to transport and produce basically everything skyrockets. This fuels brutal inflation and that dreaded economic boogeyman, stagflation, which is when prices are soaring but jobs are disappearing. Because inflation is so high, the Federal Reserve's hands are totally tied. They can't simply cut interest rates to save the economy like they usually do, so consumers get squeezed, and that ultimately triggers a market crash. It's a scenario everyone is terrified of, for sure, but understanding it is your very first step to beating it.
Here's the crucial point. A crash is essentially a Darwinian transfer of wealth. It's survival of the fittest. The middle class gets squeezed, and weak businesses that lack fortitude get completely wiped out. But those strong businesses that actually survive, they're going to multiply in value exponentially once the dust settles. Just think about Amazon for a second. It survived the dot-com crash and the 2008 subprime crisis, dropping to around $2 a share almost 2 decades ago. And since then, it's become a massive generational wealth creator. Pure survival is the key metric here.
Moving on to part two, avoiding the cyclic trap, because panic is absolutely not a strategy. We really need to talk about why our most instinctual reactions to market chaos are actually a massive trap for retail investors.
80%. Let that number sink in for a second. When a crash hits, human instinct screams at us to sell everything and just sit in cash. But if you try to play it safe by fleeing to a 100% cash position, inflation is going to quietly steal 80% of your purchasing power over a 25-year period. You might feel safe in the moment, but you're getting cooked like a lobster in a gradually boiling pot of water. Crashes don't kill portfolios. Inflation and impatient, impulsive behavior do.
So when chaos hits, your choices are incredibly stark. The losing strategy? That's chasing cyclical commodities like oil, hoarding cash, or panic selling. Oil is super cyclical. It shoots up to 120, drops back down to 60 over and over again. There's literally no point holding it for a decade. The winning strategy, on the other hand, is buying quality, mission-critical assets systematically at a massive discount. You want to buy the winners that are going to scale huge over the next decade, while the rest of the market is temporarily pricing them at cents on the dollar.
All right, part three, investing in AI infrastructure. We're talking about the picks and shovels. We're pivoting from abstract economic threats to a very specific shopping list of mission-critical AI infrastructure.
First up on that list is AI energy. Look, AI is the most power-hungry sector we have ever seen. But again, you don't want cyclical oil. You want non-grid dependent power sources that actually compound with technology. That brings us to companies like Constellation Energy for nuclear power, Vertiv for advanced cooling systems, and Bloom Energy for on-site production. These companies offer an escape from fluctuating oil prices and grid dependency, which makes them absolutely vital for this incoming AI supercycle.
Next, we have the massive memory bottleneck. As AI agents get 10 times more complex, they naturally require 10 times more memory. And get this, right now, just 3 companies control 90% of this entire market. Since it takes at least 5 years to build out production facilities just to compete, these incumbents are going to completely dominate. A huge standout here is the US-centric Micron. They're boasting a staggering 3,000% free cash flow growth. That's the actual cash left over after operating expenses, making them perfectly positioned to supply the high bandwidth memory that AI data centers desperately need right now.
And rounding out this infrastructure trifecta are the absolute production monopolies. I'm talking about the companies physically making this tech revolution possible. You've got ASML, which is essentially a monopoly building the ultra-complex lithography machines required to print microchips. TSMC is actually fabricating those semiconductors. And of course, you have the powerhouse designers solving the GPU bottleneck, like NVIDIA and AMD. During times of geopolitical chaos, owning these irreplaceable monopolies is critical.
Part 4. Building a resilient portfolio and managing the chaos. Let's explore how to fortify your investments with companies specifically designed to thrive when geopolitical uncertainty hits the fan.
You absolutely have to own companies that help manage supply chain and data chaos. Take Palantir, for example. It's practically the only company in the world built specifically to help organizations make critical decisions during times of absolute chaos. Combine that with CrowdStrike for uncompromising cybersecurity and Datadog or MongoDB for total system visibility. These aren't just luxury software products anymore, guys. They are literal survival tools for major corporations during a crisis.
Now you pair those chaos managers with real-world productivity engines. We're talking about companies that help us function better despite high oil prices or economic strain. Think Tesla's massive advancements in robotics and full self-driving. Think Meta's incredibly efficient advertising platform. Then there's Amazon, which holds this unique, super lucrative blend of AWS cloud computing and massive retail data. Throw in disruptive financial platforms like SoFi and Robinhood, and you've got a rock-solid foundation of real-world impact.
But listen, having a shopping list of the right stocks isn't enough on its own. You need a strict execution system. So how do you actually do it? First, anchor your entire strategy with a large S&P 500 core. Don't trick yourself into thinking you can outsmart the whole market with individual stocks alone. Second, rely on methodical dollar-cost averaging during market dips. Never use margin or debt, and absolutely no panic buying. Buy slowly. You never know exactly where the absolute bottom of a crash is, so you need the patience in the system to weather a drawn-out buying process.
Finally, we've arrived at part 5, the only metrics that matter. It's all about signal versus noise. We're going to cut right through the relentless media chaos to reveal the only financial metrics that actually matter for your long-term wealth.
Think about the last 25 years of relentless market growth. It has been a total roller coaster. We survived the 2000 dot-com crash that resulted in a quote-unquote lost decade, the brutal 2008 subprime crisis, the sudden 2020 pandemic shock, and the 2022 bear market. But what happened overall? The broad market relentlessly grew from 1,500 points to roughly 7,000 points. The world doesn't just stop. Chaos, wars, and recessions happen constantly, yet the market endures and grows because of underlying revenue and profit expansion. Now, the absolute most crucial step here is strictly separating the noise from the signal. The media wants you to panic over high PE ratios, which is basically just how expensive a stock looks compared to its earnings today. They hype up insider selling and endless news cycles. That is all short-term noise. The undeniable signal, literally the only thing you should be looking at for long-term holds, is the development of revenue, gross margins, and operating margins over a 5-year period. If a company is expanding its margins year over year, it is a winner, period.
Let's put this into perspective with Palantir. Say you get in at an initial buy of $6 when it's totally under the radar. Then, the hype cycle pushes it all the way to 200. Then, market chaos drops it back down to 145. If you're a long-term investor, you completely ignore all of those wild swings. Because despite that massive price volatility, the underlying revenue and margin development is what dictates its true trajectory. The stock price will eventually follow the earnings. That is the one certainty you can rely on. So I'm going to leave you with this final, provocative thought for today's explainer. When the inevitable macroeconomic shock finally hits, and it will, how will you choose to react? Will you let inflation silently cook your savings in cash? Or will you trust the long-term metrics, rely on a strict execution system, and buy the mission-critical infrastructure of tomorrow at a massive discount? The choice is entirely yours. Thanks so much for joining me on this explainer, and keep learning.